Hello guys, and welcome to another developed video. Today taking an in-depth look at Cisco Systems Incorporated, an American multinational digital communications technology conglomerate headquartered in San Jose, California. Cisco develops, manufactures, and sells networking hardware, software, telecommunications equipment, and other high technology services and products. I think you probably know about Cisco Systems. I don't think I need to tell you that much. Um, Now, first of all, let's start with their stock price performance. We can see that in the past 365 days, their stock price has increased. First, let's move after that to business metrics. We can see that their ROIC is near 11%, so they're a good return on invested capital, not extremely great, but pretty good. Their return on equity is 22.7%, which is, in my opinion, pretty good. And the return on tangible assets is 19%, which is also really, really good, in my opinion. The curve ratio is 0.91, which is, if you know, the curve ratio is basically the short-term liquidity of a company. So you get current assets minus inventory divided by current liabilities, and it is a great metric which perfectly assesses the company's short-term liquidity. We can see also that they have a dividend with a payout ratio of 62% and a dividend yield of 2.56% uh, as of 2025. The price to earnings ratio is 27 and their market cap is 250 billion. Let's move on to Graham's valuation. I plugged in the 2025 estimated earnings per share, which is $3.66. And using Graham's revised formula, we get an acceptable buy price of $85.89. Moving on to the discount cash flow model, we can put in an average growth rate. I believe that 3%, 3.5% is pretty good. Although I know it is above their average growth rate, their free cash flow is expected to pick up in 2025 and 2026, so their growth rate would probably be closer to 3.5%, and then with a perpetual growth rate of 2%, with a discount rate of 8%, we get an intrinsic value of $40 per share. Moving on to the dividend discount model, assuming a 5.5% growth rate, so in line with free cash flow, and a 8% discount rate, as we used in the discounted cash flow model, we get a DDM price per share of $36.8. Now moving on to the outputs, to the final calculation. Using the averages of all three, we get an intrinsic value of $54, and applying a 15% margin of safety, we get an acceptable buy price of $46. So well below the current price. This means that the current price is not a buy, but if it ever reaches 45 or $40, then it is a buy. Now for a short commentary on Cisco Systems. Cisco, if you remember correctly, was a very popular stock about 20 something years ago in the 2001 dot-com bubble. People compare Cisco nowadays to Nvidia. So if you were from back then you know by now that Cisco is very similar to Nvidia in the sense that at one point they were extremely hyped up. Now Nvidia hasn't gone through this cycle, so Nvidia hasn't been through the cycle where they've been extremely hyped up and then become a permanent dead stock for 2 decades. But this is what happened to Cisco. Uh, Cisco was a great stock to own for a few years, for some time actually, until the dot-com bubble burst. And from then on to now, they haven't fully recovered if you account for inflation. So the stock price is actually lower now than it was 20 something years ago. The problem with their business, as you've seen from the discount cash flow, is that they really don't grow that much. Sure, they've had some growth until 2023, and now they'll recover. But if you think about it, if in 2026 they reach the levels of 2023, so 19 billion free cash flow, they will have gone from 11.3 billion to 19 billion in 11 years. So that is, and if you account for inflation, that is basically no growth. They've done nothing. I think actually that no, I think actually that's less than no growth because if you remember the inflation for 2019, 2020, 2021, and so on and so forth, and if you add it, then I think that actually they're growing. They're not growing at all. They're actually declining if you adjust for inflation. So this is pretty bad. Also, if we look at their payout ratio, as I've said, is 62%. And if their free cash flow only increases at 2% or 2 or 3.5%, all that means is that after taxes, you're basically keeping your money in a safe that's protecting it from inflation. And I think investing in bonds is a better alternative to Cisco. But if you really want to invest in the stock market right now, I think Google is just such a great opportunity. I've recently done a video on Google. They're trading at a great valuation. They've got great business metrics. Also, Cisco doesn't really have bad business metrics. It's just that they're overvalued. So a 27 price to earnings for this company is absurd. They they do not even deserve a 20 PE or even a 20 21 and 22 price to earnings. So 27 is too much for them. I think they deserve a 15 price to earnings at most for their mediocre growth. But as I've said, their dividend yield will not increase that much. There is not much growth here. There is not much value here. Their balance sheet is not extraordinary. A 0.91 current ratio is okay, but not really that good. It's not like they're flying with money, or their ROIC is 11%, which is also okay, but it's not that great. I suggest you look at let's look a bit at Google because I have to show you that Google is a much better buy in my opinion. Let's let's just look at the business metrics. You can see return on tangible assets 23%, um, current ratio 1.84, so much better. Return on equity 31%, also much better. Payout ratio only 7.35%, so they have much more room to grow here. Now let's look at the DCF quickly, and we can see that using you can see their huge growth rate, and we'll just plug in a 8%. Actually, no, I think they deserve, yeah, I think 8.5 is much better. Their 8.5% growth rate with a perpetual 2.5%, and we get an intrinsic value of 161. I know this is below the current price, but to be honest, in today's market, everything is overvalued, and their stock price is much closer to reality than much of the other companies. And what should be of note here on Google is that Google also has a pristine balance sheet with buybacks and also a shitload of cash, things that Cisco doesn't have. So yeah, I think this has been it for today. I think we went a bit long with Google, but still, I suggest you buy it. It is a great company. Cisco, not so much. Cisco deserves a 15 price to earnings. If you find it a 15 or 14 price to earnings, then yeah, you should buy it. But with today's growth rates, with today's valuation, they do not deserve even a smidge of a buy. The tool I've used today is ticker data. I think you've seen, you just plug in a ticker symbol here. All of the things are calculated automatically. This is ticker data. It is in the description below. It is a great tool. I use it for my videos, as you can see. I suggest you also check it out. It also has great templates. So not only does it have this API, it also has great templates. So I really suggest you use it. Uh, Also, do not forget to check out my investing blog from the link in the description below. And I hope to see you in the next video. Bye.